For most of the 20th century, if you walked into a bank and asked for a loan, a human being decided whether you got it. That person could weigh your race, your gender, whether they liked the look of you, whether your neighbourhood was the right kind. Not illegally, routinely. Two men, an engineer and a mathematician, decided this was a problem that mathematics could solve. Replace the loan officer's judgment with data. Replace discretion with a formula. Output a number. The number decides. They called the company Fair, Isaac and Company. Today it is called FICO. Fair and Isaac pitched their system to 50 lenders in 1958. Very few adopted it. For the next 3 decades, the credit industry continued doing what it had always done: personal assessments, local judgment, persistent bias. Adoption was slow, and for decades it remained marginal. Then, in 1989, FICO launched its first general-purpose score, a single number between 300 and 850. The 3 major credit bureaus adopted it by 1991, and in 1995, Fannie Mae and Freddie Mac, the government-backed mortgage giants, required standardized credit scoring for residential mortgage underwriting, and FICO quickly became the dominant model. That standardization helped turn an ignored idea into the infrastructure of American home ownership. Within a decade, the vast majority of top US lenders were using FICO scores. The algorithm the banking industry ignored for 30 years had become the standard by government requirement. The credit score was an American invention. The idea it introduced was not. The idea is this: trust can be calculated. Instead of asking whether we trust this person, institutions began asking, what is the statistical probability this person will repay? That question is now asked in most developed financial systems around the world. In India, your CIBIL score determines whether you get a home loan, a car loan, or a business loan. In Germany, your Schufa score can affect whether you can rent an apartment. In Britain, 3 competing bureaus each produce a different score for the same person from similar credit data, which regularly confuses the people those scores are supposed to describe. Different countries, different institutions, same structural design. A private organisation calculates a number about you. That number controls access to things you need, and the formula is not public. Fair and Isaac designed their score for one purpose: to predict whether you would repay a loan. One door. The score is now used for rental applications. Your landlord checks it before deciding whether to let you live somewhere. For employment, in many US states, employers can review your credit history before hiring you. For car insurance, your premium is partly calculated from your credit data. For utility accounts, the number that was built to open one door now stands in front of every door you need. None of these sectors were part of the original design. The score was originally validated for credit risk. It expanded because it was convenient and because nobody built a law to stop it. One company owns the dominant credit scoring formula used in US mortgage lending. That company is not a government, not a regulator. It is a private corporation whose stock has risen several 100% over the past 5 years. Its price for providing mortgage lending credit scores has reportedly risen by more than 400% since 2022. The Consumer Financial Protection Bureau's director at the time described it as, effectively, a tax on every mortgage application in the country. Senators from both political parties have written to the Department of Justice calling FICO a near monopoly and demanding antitrust action. The formula that produces the number governing your access to housing, credit, and in many cases employment remains proprietary, and you are judged by it without ever seeing it. By 1958, Bill Fair and Earl Isaac were trying to replace the loan officer's biased judgment with data. They were right that the system needed changing. What they could not anticipate was that their formula would be captured by one company, expanded far beyond its original purpose, and priced as a toll on every economic transaction that requires a credit check. A tool built to standardize judgment became a proprietary number nobody voted for, governing access to the things that define a modern economic life. That is what institutional capture looks like when it happens slowly enough that nobody notices. If you want to understand the systems that shape economic life before they shape yours, subscribe.